Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we finalized our discussion on the basics of interest rates and introduced the Federal Reserve. In today's lesson we're going to look at the parts of the Federal Reserve which are relevant to us as traders so we can begin to understand how this one institution can have such a drastic effect on the markets. So let's get started.
Okay, so the Federal Reserve has many responsibilities, which include regulating banking activity, playing a major role in operating the nation's payment system, and maintaining the stability of the financial system. The role that is most important to us as traders, and therefore the role which we will concentrate on in our lessons, however, is its role in conducting the nation's monetary policy. As a side note here, the Federal Reserve is also the central bank of the United States. I say this here because most countries have something which operates in much the same way as the Fed, which is many times referred to as that country's central bank. While these institutions may be structured differently from the Federal Reserve, from a broad perspective, many of the things that you learn in our lessons on monetary policy on about the Fed here will apply to any central bank for any country around the world. While the Fed's objectives are set by law, its day-to-day activities are not subject to government approval. This is an important point to understand, as it means that unlike fiscal policy, which must be approved by both Congress and the President, monetary policy can be enacted as the Fed pleases. This gives the Fed much more control over the economy, at least in the short term, and is the reason why some people consider the chairman of the Federal Reserve to be more powerful than even the President. There are many interesting details about the Fed and its structure that I encourage everyone to explore. However, the primary components which move markets and are therefore the ones which we will focus on are the Board of Governors. Located in Washington, D.C., the Board of Governors is at the top of the Fed's food chain. The Board of Governors is made up of 7 members who are appointed by the President of the United States and confirmed by the Senate. To help keep the Fed from being influenced by political factors, 5 of the Fed governors are appointed to staggered 14-year terms. The chairman of the Fed and vice chairman are appointed to 4-year terms and can be reappointed should the president wish to have them, whoever the president is at that time. The next component is the regional Federal Reserve banks. This is a network which includes the 12 regional Federal Reserve banks and 25 branches. As most of you already know, different areas of the United States are comprised of different industries. As an example, the New York area economy is influenced heavily by what's going on in the financial services industry, while the San Francisco area economy is influenced heavily by what is happening in the technology sector and not so much in financial services. As this is the case, each of the regional banks are strategically located throughout the country so that they can stay abreast of current economic situations in each area. The 12 regional banks are located in San Francisco, Dallas, Kansas City, Minneapolis, Chicago, St. Louis, Atlanta, Cleveland, Richmond, Philadelphia, New York, and Boston, as you can see on the map there. The third component, and most important of all, is the Federal Open Market Committee, normally referred to as the FOMC for short. This part of the system is made up of the Board of Governors and the 12 presidents of the regional reserve banks. The FOMC is the most important part of the Federal Reserve from a trading standpoint, as it's this entity that is responsible for monetary policy. Under normal circumstances, the members of the FOMC meet 8 times a year to discuss economic conditions and vote on what, if any, monetary policy actions should be taken. The voting members of the FOMC are the Board of Governors, the president of the Federal Reserve Bank of New York, and the 4 presidents of other regional banks who vote on a rotating basis. So as you can see here, the Board of Governors, the 7-member Board of Governors, each one of them has a vote, and they vote in every monetary policy decision, and then the New York Fed president does as well. So you can see there the Board of Governors being the most important of the component of the FOMC, and then the New York Fed president being the next most important component, and then the regional banks, which vote on a rotating basis, being the third of importance. And that's an important point to understand, because when these people speak, differing weights are placed on what they say by the market, depending on where they lie in the food chain there. As we've discussed in previous lessons, there's no greater mover of markets than changes in people's anticipation of interest rates, and as the FOMC has the most control over interest rates, one could say that there is perhaps no greater mover of markets than the FOMC. It's for this reason that markets can go quiet for days in anticipation of an FOMC interest rate announcement or important speech by the chairman or other voting member, and then explode with volatility shortly after. So now that we have an understanding of its structure, we can begin to discuss how the Fed goes about enacting monetary policy, what this means for the economy, and therefore how the markets are likely to react in different scenarios, and how we may be able to benefit or avoid mistakes in certain situations. So this discussion will begin in our next lesson, so we hope to see you then. As always, if you have any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.